That'd be awesome. That'd be absolutely awesome. Okay? Okay, so reoccurring revenue is important. Now, I'm going to talk about this one because about 20% of the companies in America do it. The other 80% don't. So I'm going to divert here to a P&L. We start with revenue. What's after revenue in a P&L? Okay, cost of goods sold or services. What makes up cost of goods sold? Material, labor, maybe an overhead allocation. Can you think of anything else that people typically put in there? Huh? Equipment. Okay, what's after this in the P&L? So gross profit or gross margin, depending on how your accounting is set up, correct? Okay, what I'm going to do is leave a space here, and then I'm going to put admin costs, or SG&A, or overhead, or however you want to put it, right? And by the way, it typically goes from A to Z. It's alphabetical. How many of you have a salesperson where you pay a base and a commission? Anybody? Okay, about half the room. So we've got a base and we've got a commission. Now I'm going to introduce what's called a variable expense. Who can tell me what a variable expense is versus a fixed expense? It's a function, you agree? A variable expense is a function of revenue. In other words, you're not going to pay it unless you have some revenue event. That's typically up here, right? What is the base, fixed or variable? Okay, this is fixed, right? What is the commission? Do you know where I find that booked? Down here under marketing and sales, base and commission sit down here. All right? So what I want you to do is not change this because the banker is used to a certain format. So I want you to add in variable expenses. So over here, we're going to add in the sales commission. Okay? Now, after looking at over 100 of these, somewhere between 2 and 10% variable expenses are hidden down here in admin. Why in the world am I even talking about this? So you add up all, what are some other ones that you can think of? What about that? Okay. Okay, cool. What else? You could have legal fees that are proportional to your revenue, right? You have maybe some fixed fees, but you may have some legal fees. How about freight? You know, sometimes you have freight for shipping, then you have postage and other things. Typically it's put the same. All right, so we have some legal things that are proportional to, they're a function of revenue. We have, what did you call it? Merchant. Yeah, merchant fees for sure, right? Merchant fees, right? And there's others, okay? Now, what this gives you is called the contribution margin. How many in here are making decisions on what your gross profit or gross margin is? Everybody's hand should go up, by the way. Don't you make decisions on gross margin and gross profit all the time? Well, here's the problem with this. The break-even of your company or of a division is fixed expenses divided by your contribution margin, which is this number, not that number. The reason why is because all these variable expenses that are hidden down here change the break-even. Now, I had one of my members about 8 months ago came to me and said, Dale, I've done the break-even on my company. I should be breaking even, but I'm losing $100,000. Tell me, what is the problem? We went and looked at his P&L. 7% variable costs were hidden down in here. When we took the variable expenses and put them up here and got a true contribution margin, the break-even, we were within $1,000, okay, on a $3.5 million company. People make decisions all the time up here. Gross profit, gross margin, They do financial accounting instead of management accounting. There's a bunch of variable expenses that are hidden down here, so they think they break even earlier than they actually do. Put these variable expenses up here, get a true contribution margin, and now you can find your true break even. Okay? And if you're doing that, congratulations, you're one of about 20% who do it. Thank you, dear. All right. The contribution margin. Yeah, so you have to take your variable expenses out of your gross profit, and then that's the number you divide by.
So in that example, what did you find down there? Just commissions or something?
I found commissions. I found a warehouse utilities, because if they didn't have sales, they wouldn't have the warehouse. The warehouse payment was fixed, but the utilities aren't, because if you didn't have revenue, you wouldn't be turning on the lights. So we found utilities, we found commission, we found freight that was down there, listed under postage and freight, you know, a bunch of stuff like that.
Can you give that formula again, the variable?
It's fixed expenses divided by your contribution margin will give you the break even of your company.
What is the contribution margin?
That is your regular gross profit minus the extra variable expenses that are hidden. So you take your gross profit number, you find the variable expenses that are hidden down in your admin, put them up there under variable expenses, and that gives you your contribution margin. Everybody understand that? Okay. Cash flow. Let's talk about that for a second. Who can tell me what a typical cash flow statement, oh, by the way, let's ask, who looks at a cash flow statement? Just checking. Okay, we got about half the room. Tell me what is on a cash flow statement that you get from your accountant. You get cash or bank, plus or minus, inventory, plus or minus, accounts receivable, plus or minus, accounts payable, plus or minus. You get capital expenses, plus or minus, and then this gives you net cash, right? Here's what I think of this statement. If you have a good month and you have a positive cash flow, there you are. You're feeling happy. I got a positive cash flow. If you have a negative cash flow, there you are. You're not feeling very good about it. To go and try and dissect this of where the pluses and the minus and what came from is I'm sorry, I'm an engineer, it's a nightmare. All right? I hate it. Here's what you want to do. Graph your cash, graph your payables, graph your receivables, graph your inventory change. If you will graph a cash flow, go back 2 years, okay? You can see where the seasonal things are. You can save here for these negatives, okay? Then you can also project out 12 months in advance. Really easy if you've got 12 months of or 24 months of history. To me, this is the most important statement you can get in your dashboard is a graphed cash flow instead of this nightmare, which is a mental, this is like, where's Walto? You know, you're hunting for him in there. Somewhere there's a plus and minus. Does everybody understand that? Graph your cash flow.
You're saying take all the cash expenses and all the non-cash add backs and graph them?
I'm saying you typically get this statement from your accountant. If you run a cash flow statement, graph every element of it.
Yeah, all the add backs,
Yep,
all that stuff.
yep,
Graph it.
graph it. And then within about 1 minute, you can see the health of your company because you can see what happened from last month to this month. You can see what's going on. This table right here, to me, is a nightmare.
What's the bottom line on that?
Inventory change. I love my banker. He's supporting my graph the cash flow. Graph the cash flow.